most of what you've been taught about money up to this point has been a myth, and now you're seeing the truth.
You finance your life. You either pay interest to somebody or you give up earning interest. If you're willing to pay interest or give up earning interest, you don't understand how money works. What we're talking about officially here is how money works.
Welcome back, everybody. Another week, another wealth webinar. Thanks for joining us today. Thanks for dealing with a little bit of the tech issues we had today. But you know what? One of the most important things about today is the aha moment. When you're talking about the infinite banking concept, you're literally talking about a financial concept, a financial process that will allow you to take back the banking functions in your life. But one of the biggest problems I have and that I see is a lot of people think they know what they don't know. And I'm going to give you an example. Back when I was a financial advisor from the early 2000s all the way up to 2018 when I retired and hung my hat up as a financial advisor, I will tell you this, not one time during my entire financial advisory experience and journey did I ever or was I ever told about the infinite banking concept. I knew all about whole life, knew all about all sorts of insurance. I knew about everything, or at least I thought I knew about everything. And it all came down to this one moment where I was shown this concept, what you're all going to learn, the infinite banking concept. I was shown this while talking to a real estate investor who was lending me money. The first response I had, because remember, as a financial advisor, and at that point about 14 years, in my mind, I knew everything there was in the financial industry. I knew all the products, I knew all the tricks, and I knew all the strategies. So when I heard about this and the way that Mike, that investor, explained it to me, I'm like, no freaking way. And he explained it very simple. He said, guaranteed interest, dividends in a tax-free environment, protected against judgments and liens, private, don't have to report it to the government, and it provides a legacy. And when you use your money, you still earn interest and dividends on all of the money, even though you get to use it to make money a second time. When I heard all of that, all I could articulate is that each one of those little things I was trying to fit into a box, a financial box. And as I got down that line of what Mike told me, I couldn't figure out what the box was. But you see, I knew all about it the entire time, but I couldn't make sense of it. When I finally grasped this concept, I remember vividly, I went to my old general agent, okay? So I worked for a company called New York Life. That's where I started my career. It's not where I finished, but it's where I started. I knew the manager there very well. His name was John. And I took John out for lunch because I had nobody else to really ask this question to. And when I sat him down, I said, John, I just have one question for you. Do you know and have you known what the infinite banking concept is? And he very quickly said, yes, I know exactly what it is. It's kind of like what banks do. And he goes into that. And I said, okay, John, I spent 14 years at New York Life. All those years, I was one of your top 3 advisors. I said, why is it that you would have not taught us? Why is it that Walt, our training manager, would not have taught us about this amazing concept that would have changed my clients' lives, that would have helped my clients solve their problems? Why is this not shown to the advisors and the agents that you recruit? Took a bite of his food very calmly, and he said, you know, Chris, I want you to remember back to when you just started as an agent. And I said, okay, I remember. He said, do you remember the room that you were in, that new org room? I said, oh, yeah, I remember it vividly. Walt was up front teaching us, and you were there. And he's like, yep. He said, how many people were in that room? And I vividly tried to remember. It was a pretty full little conference room. So I'm like, I don't know, 20, 22? And he said, yeah, there was 23 people in that room, give or take. And he said, now I want you to think through the first year, when you were back in that room the next year, how many of that new org group were left? And I thought through, I said, well, maybe there was 10. And he said, pretty close. He said, go to the third year. How many of the new orgs that you started with, those 23 people, were left after the third year? And I had to think long and hard about this. And I'm like, third year. I'm like, there was me. It was just me. And he said, so in 3 years, we went from 23 potential financial advisors to you, 1. He said, that's about the average. And he said, that's if you make full commissions on all the things you are. You see, this is an industry that's very hard to survive in, and very few make it, but the ones that do very well. So he then said to me, so in order for us to have maintained that type of retention of advisors, he said, if we taught all of you day one about the infinite banking concept, about how to design this policy so that it really benefits the client with high early cash value, and so that when you design that, you have to load it up with paid up additions, reduce the base, and what does that do to your compensation? I said, you're right, John. We have a commission that is 60 to 90% less than what the regular life insurance product sells. He said, right. So you got this product that only works for the infinite banking concept, especially designed and engineered whole life, that now reduces your compensation by 60 to 90%. Let me reframe that question. 23 start, the second year about 10, the last year are you still there if you made 60 to 90% less? I had an aha moment. You see, the truth is I wouldn't have been there. I wouldn't have been able to make it. There's no way I could have made it. There's no way any of those agents would have had a fighting chance if all they did was the infinite banking concept, because we needed the full commission. So much so that the insurance company actually gave us it was like a allowance. I can't remember what they called it in the beginning, just so we could survive. This is a tough industry, folks. So in today's training, I've got a guest who I'm going to introduce in a second, but what we're going to talk about is the myths. But we're also going to talk about the one thing I say a lot, which is Will Rogers' quote, the biggest problem in America is not what people don't know. The biggest problem in America is what people think they know that just ain't so. I'll give you an example. You have probably heard this one before, that the Great Wall of China can be seen from space, right? Myth. You can't see the Great Wall of China from space, but you've been probably told that in your life. Let me go on one other one. Believing that Columbus proved the earth was round. On his grand voyage, Christopher Columbus sailed the mighty seas and proved that the earth was round. Bullshit. Everybody knew the earth was round prior to that, at least almost everybody. But that's what we've been told, right? Columbus discovered the earth was round. The Great Wall of China is visible from space. These are just a few of the myths. So let me then rephrase the question is, in the financial world, in what most of you are taught and most of you are operating under the pretense of in the financial world, is it the truth or is it a myth? Well, that's what we're going to talk about today. And I got one more. This is a really unique one, and Nelson Nash said this, so I'm going to read it verbatim. When people truly grasp the infinite banking concepts, they rush to act, not because they're being sold, but because for the first time, they see the truth. When we transition that mindset over to the thing called the Grand Canyon, once you've seen the Grand Canyon in person, no amount of explanation, no amount of photos can ever show you that same thing that you saw in person. It can't compare. It changes how you think, folks. The infinite banking concept is exactly the same. Once you see it, you can never unsee it. My guest, Marty, has been in this industry a long time. We talk to Marty all the time, and I'm going to turn it over to him because he's definitely studied Nelson Nash. He's been using and talking about this for years, but I'm going to turn it over to him because he had this thing that he sent out to all of us brokers, and I thought it was fantastic. But I'm not going to steal his thunder. I'm going to let him explain to you. And then what we're going to do is we're going to look at something, and I'm going to frame this up. We're going to look at something that will blow your mind. That once you see it, you will never, ever be able to unsee it. Once you see what we're going to teach you today, I promise you, no one that ever tells you buy term, invest, the difference is better will ever hold any water to you. You will know the mathematics and the proof because I'm going to break it down. But let me turn it over to Marty. Marty, welcome to Wealth Webinar.
Well, thanks so much, Chris. I really appreciate being here. It's a lot of fun. Great to be with your audience here. I love listening to you. I love that opening video. Rock 'em, sock 'em, man. I'm telling you, I believe that more than anything. That is my passion there. So it's quite astonishing to me that it's just wonderful to hear people say this. And this is the kind of guidance, the kind of truth telling that needs to take place, certainly with the people that we deal with, because we want everybody to become their own banker. We want them to understand the infinite banking concept so that they get it. And the thing is, just like you said, and I spent a lot of time with Nelson Nash while he was alive here. And the crazy thing about Nelson is that he just, when you understood the concept, it's exactly what you were saying. We don't sell the concept. People see it, they recognize it, they understand what it's going to be. So I don't know if it's possible, Chris, but you might, if you could use the whiteboard behind you there, I wanted to see if you could draw a little picture for me. And
Certainly.
this
Let
is
me
kind
get,
of a moment that sort of made me understand things. So if you could put a line straight across that board, we'll call that the zero line, just right in the middle, the zero line. So if you
got
think
it.
of yourself as a young person there, where do you start out? Well, normally you don't have money, whatever, but hey, you might have a job. That's great. So what's the first thing you're going to do? Well, I live in New York City, so I just hop on the subway lots of times here. But if you don't live in the city, you might want a car or you'll need a car to get where you want to go. So the thing is, in order to get that money for that, what do you got to do? Well, you have a job. So people are willing to do what? Lend you money, right?
Absolutely.
So if they're going to lend you money, so let's say you take a loan, right? And so you're at the zero line to begin with. So if you just draw a line straight down, like if you think of the axis there, right? You're gonna draw a line from the zero line down, say like, imagine it's gonna cost you whatever it is, 25, 30, 40, whatever the car would cost at the time. So
Where do you
if
want
you
me to
just
draw
had a
the
little,
car?
no, I just want you to draw, starting to your far left, on your left, right? I
Okay.
want you to draw a line down, just like halfway, right? And then I want you to say a year later, nope, you don't have to do that, but it's okay. You're going to draw a line like you're taking a loan. So you're going to draw it like halfway down.
Oh, I see what you're saying.
Right,
Let's do
right.
that
So
right here.
just draw a line down showing that you're going to take a loan, right? Just straight down.
Yep.
All right. So now what do you do when you have a loan? Well, you got to pay it back. So how do you do that? Well, you're going to stair step it back up to the zero line. So it's like a
Yep.
stairs
Monthly
going
payment,
back
monthly
up.
payment,
That's
monthly
it. Like
payment,
4 years,
monthly payment.
you're going to pay it up. And so it goes up. So that's great. So what happens the next time you got to take a loan?
Same thing.
Same thing. You can go down and then you're going to step it back up. Right. All right. So after you've taken a loan, where do you end up at?
Same place you started.
The zero line. Now, but there's other people the way that they can do it, right? There's other people, myself included, was a saver. So what would I have to do in order to buy a car? Well, I'd have to delay my gratification. So if you just draw a line in the opposite direction, if you just stair step up the line like that, if you go stair stepping up just like that, that's right.
You're
Stair step it
saving.
up there till you get to that point and then stop. And so what is going to happen when it's the best day and the worst day when you accumulate your money, right? What are you going to have to do? You're going to have to take a loan. I mean, you don't take a loan. I mean, you're going to spend your cash, right? And once you spend all your money, what line are you at again?
You're back at the zero line.
That's great. And then when you want to, and so what do you have to start doing right away? You
You
have
got
to
to start
start
saving again. So we got to,
stepping it up again. Keep it going
yeah,
up. Keep it going up. And then you get to that point, and what do you have to do? You
spend
spend
it.
it.
But we got ourselves a cool car in the driveway here.
Oh, that's great. I love it. Yeah. But guess what happens? This is the way that normal people live. You
It's the way
either,
I used to live.
right? The whole point about this is if you don't have money, you either have to take a loan and pay interest to somebody else, or if you're a saver, you spend money and you're never going to earn interest on that money again. That's just the great rule. You finance your life. You either pay interest to somebody or you give up earning interest. It's a horrible situation. How many times did you have to do this before you realized, guess what? What's the difference between somebody who saves money and a difference who has to loan? Oh, they end up in the same place. They're at the zero line.
Yeah.
Wow, what a horrible situation. But then I ran into Nelson Nash and a few other people, right? And so what did they teach me? Well, they said, well, most people think that there are only two ways to finance your life. But guess what? There is a third way. And that third way is if you are able to become your own banker. So what does that mean? What's the whole difference there? That zero line is a terrifying thing when you're there, you're just starting out, you're married, you're having kids, and where you get, you run up into the same place. How do you get ahead? That's the terrible place I always felt. But think about this. What happens when you have a life insurance policy? a dividend paying cash value whole life insurance policy, the best financial product that's ever been created. If you would plot the way that cash value would grow in that policy, what would that line look like on this graph? It would be sort of you'd start
Kind
at
of
the
like
zero line. It wouldn't be a linear line. It would be an exponential line like that. So now think about this. What is the title of Nelson's book? Becoming Your Own Banker. So what does that mean to become your own banker?
take
Well,
back
that means
control of functions.
you take back control. This is all about taking back control. This is what you want to do. You want to be at the mercy of the market? No, I want to be with the life insurance policy, the dividend paying whole life insurance policy that works on guarantees and dividends. Oh, what happened? Oh, hey, Chris, I got to ask you a question.
Yeah.
My life and all my whole life insurance policies. What's happening to the cash value today? Is it growing?
It has to grow. Can't do anything
What
else.
happened yesterday?
It
Oh, it
grew.
grew too. What's going to happen tomorrow?
Well, you'll have more money today than you did
It just
yesterday.
keeps going. So think about this. So Chris, take a point on that line, that tilted line there, and pretend that you're gonna borrow from your policy.
Okay.
So
we're
we're
gonna
gonna
go
go
right
down. Right. So we're gonna take a loan. So we're gonna go down, right? And then what do? We're gonna repay the loan, and we step it back up. But take a look now. We've repaid the loan, and where am I? Am I at the zero line, or am I at a higher point on that? Am I at the higher point on my exponential line?
You're higher because the cash never stopped. You didn't lose this earning potential, that opportunity for your money to earn. Your money continued to earn. And when you
That's
took
right.
the money, you didn't use your money. You used the insurance company's money.
I use the insurance company's money. Exactly. So what happens if I take another lot? If I take another, let's say I take an even bigger loan because I have more money I can borrow and I pay it back. Where is it
Same
always
thing.
going to end up?
Same
Higher.
place.
It's going to end up, it's always going to be higher. I mean, it's when you think of this phenomenon, if you just look at this picture, if you're not doing this concept, if you're not taking control of your financial life, if you're willing to pay interest or give up earning interest, you don't understand how money works. What we're talking about officially here is how money works. This is the way that we need to do this. This is the way that we grow it. Because the crazy thing about this, when you create your own dividend paying cash value whole life insurance, you really have an excellent idea of where you're going to be in the future, right? If I was a 30-year-old and I put $1,000 a month into that policy, 40 years from now, when I'm 70 years old, when they're going to tell me I can take Social Security for a 30-year-old these days, how much money am I going to have in this one little financial vehicle that I have here? It's going to be over 1.2 million bucks. Think about that. I know what I'm going to have it's predictable. What's my death benefit going to be? Well, it's going to be almost twice as much as that. Everything about this is working in my favor, is under my control. When I have to get a loan from someplace, what kind of forms do I have to fill out? If I go to the dealership, if I go to the bank, if I go to some other financing area, person, whatever, I'm going to have to do all this stuff. But in this way, all I have to do is call the life insurance company, and you know what they're going to ask me? They're going to say, oh, what's your bank account number and your routing number? We'll put it in there today. That's how easy it is to get a loan. Are they going to ask you a question about what you're going to do with it?
Nope.
No. The whole point about this is, and this exponential line going up is a great way for everybody to understand that guess what? Guess what? You're in control. You're not taking, whose money are you using? You're using the life insurance company's money. Your money never leaves the policy. You're using the process of collateralization. By collateralizing that money in the cash value in your policy, the life insurance company is willing to do this. But now think about it like this. I deal with a lot of agents in my life. So I'm driving down the highway in New Jersey. I was driving down Route 17 and I'm with another agent and he's telling me, oh, I'm going to buy a brand new Mercedes. I'm going to trade it in. And so I said, great. Now, how are you going to do it? He says, oh, well, I'm going to get a loan from Mercedes. I said, what? He says, oh, yeah. I didn't qualify for 0% financing. I qualified for Mercedes financing. I said, oh, okay, great. So the point is you're going to trade in your car. You're going to get a new one. You're going to pay back interest. You're gonna have to pay back principal and interest. It was like 48,000 in principal. If you totaled the interest, what they expected over the next 60 months, was going to be another, almost 4,800 bucks, right? The way it was. So I said, and what are you going to have to show for it at the end of 5 years? Well, you got a 5-year-old car. And then what are you going to do? Well, I'll probably trade it in again and do this. I said, but think about this. After all the times that we've talked about becoming your own banker, let's say you went down to the dealership and you had a life insurance policy. You go to the dealership, they say, hey, I said, if I were to buy this car in cash, if I was going to pay this car in cash, how much would it cost me? Well, let's say you're the worst negotiator possible. No, it's going to cost 48,000 whether you pay cash or whether you finance it. What do you care? All right. It's just one of those things. So what you do, you call the life insurance company, you get the money. You pay the cash for the car, and then what do? Well, you're going to be a good banker, right? You're either going to pay back what you would have paid back to the dealership, or you pay back what the life insurance company wants. It doesn't matter in terms of interest, because what's going to happen at the end of those 5 years? At the end of those 5 years, every time you pay back a loan, it's paying back the principal portion there, right? So the point about this is every dollar that you repay for a policy loan, the entire loan principal, the entire loan interest shows back up in whose pocket? Well, it shows back up in your pocket. That's what this is all about. Not only do you have the 5-year-old car, but you have the total loan principal, the total loan interest, plus there's a third element that we don't talk about. And that third element is the growth in the contract as it is on that exponential line going up towards 1 million there. So there's really 3 components. You get back what? You get back the loan principal, the loan interest, plus the growth in the contract there. That's how it works there. That's why the line continues to go up. That's why at the end of this, of your life, whatever, or the end when you're going to start taking money maybe to supplement your retirement or supplement your income in later years, it's all going into for whose benefit? It all goes in to your benefit. That's what this whole point is about here. And this was the moment for me when I realized my whole early years of working and trying to get ahead, whatever. I saved, but then what happened? I had to spend it. And then I had to start saving again. And my wife would always say to me, well, how much money do we have in the bank? I said, well, we got a car. Great. That's great. What are we going to eat tonight? Oh, okay. Well, I got to start saving again. That's the crazy part about this. The point is, imagine at an early age, start putting in the amount of money that you would have spent for your first car, and do it where? You put it inside a life insurance policy, inside this most wonderful product that's ever been created. What is going to happen then? Well, then you take control of your financial life. This is just the beginning. This is for my son. This is for the Smith-Berg family bank. Ultimately, that's going to happen. How many of these policies do I own? Well, I'm going to keep owning them as my income and success in life increases there. When I first met Nelson Nash, Chris, how many policies did he own?
Oh gosh, I don't remember from the book. It was a lot. Was it like 50 or was it over
When
100?
I met him, he had 43 policies that he owned individually.
Hmm.
He owned them individually on himself, on his wife, on his adult children, on every
I'm
grandchild.
catching up.
And he was an entrepreneur, so every business he had, he insured all his entrepreneurial partners too, and kept those policies. Because how long do you want to pay your policy? How long do you want to pay your premium?
As long as I can.
Now, the crazy thing is, I'll bring this up. Unfortunately, this past year, my wife, she lost her battle to cancer after 6 years. It was pretty tough, but I had my son come over and I had all my life insurance policies that obviously she was the primary beneficiary. Now he became the primary beneficiary out of the bank. And so I said to him, I said, dude, that's what we always say in New York City, because you don't want to say your kid's name in New York City because who knows who's going to be walking behind you to defer, whatever. I mean, that's the way it used to be. That's the way it still is. Crazy. But the point was, I said to him, let's lay out all the 5 policies. Let's look at where we are right now. So write down these 3 numbers: the premium, the cash value, and the death benefit, right? What's everything current there, right? So we did that for 5 policies. And so I said, the real issue becomes now, who is going to be the recipient of the Smith-Burke Family Bank? I said, you are. That's it. You're going to be it there. So let's write the numbers down. So my question to you is, what are you going to do in terms? Should I continue to pay the premiums? Or let's say I can't pay the premiums. Do you want to continue to pay the premiums? Because who's going to be the beneficiary? Well, you are, right? So, and how long do we want to pay them? So we did this. So I said, hey, take a look at me. What do you think? You think I got another 10 years, right? So I said, all right, let's put down what it currently is. I said, would this be a lot of money to you right now? He says, yeah, of course it would, right? So then I said, 10 years from now, we continue to pay the premiums. Is there more, less, or the same amount of money in terms of the cash value and death benefit? Oh, no, it's significantly higher. What about 20 years from now? What about when I'm age 100? No. Everything about this is everything that we have here. It's kind of like all the property we have, obviously life insurance policies are property. So the point about this is I want to give you as much as possible. I want to give you my human life value. And the way that I've really engineered it is to put it inside of the life insurance policies here. This is for you. He was born when I was around 33, right? So now so now I'm getting up there in age. So I said, son, if I live to age 100, how old are you going to be? Well, I'm going to be around 66, right? So if he's 66, I said, how much money do you think will be available? Think about what the death benefit is. Let's say the death benefit at my age 100 is going to be $5 million, right? So let's say that if you listen to what the banks and your financial advisors or your employer, or what your employer's telling you what to do, is to put money is to put money where? Oh, put it in the 401k. Oh man, come on. You got to put money in a 401k. You got to put it in the qualified plan, right? How much money would have to be in a 401k 33, well, less than 33 years from now, but let's say 27 years from now, so that you could walk away with $5 million tax-free?
Would it be about 7.5 million? Well, it depends on your tax bracket, but
Oh, I'm an idiot. I live in New York City too.
yeah.
So not only do I have New York State, I have New York City, right? It's almost like 50% taxes there. So you'd have to have almost 10 million bucks over the course of the next 27 years to get 5 million tax-free. Think about that. How is that going to be possible based on what you're allowed to put into them?
I'm going to do the math here. How much would you even have to save? Is that so to get $10 million over how many years? 27?
Right.
27 years. You'd need to save $370,370 per year, which is impossible because you can't put that much into a 401k under the laws. So it would be physically almost impossible for you to get $10 million in a 401k over that period of time, unless you literally found the rock star of stocks that gave you a return of, what would it be, 1,000%? I don't know. More than you'll ever get.
Let's face it. So the point about this is, so I've always said to him, where should you put your money? Don't worry about where you put your money, because we want to use the concept of leverage. We want to leverage my life, your mom's life, right? Because we want to build the biggest thing we can. We want to create the most amount of wealth using the least amount of money. That's primary rule. I mean, that's...
Marty, what you just said there, I can't comprehend why. Now, I did this. My mom's no longer insurable. She had open heart surgery back a few years ago after the pandemic, and anyway, we won't go there, but so she can't get her anymore. But like, I always felt, when I was an advisor, one of the best places I could put money is into premium for my mom. Not only did I buy my mom a couple life insurance policies and pay for them, I do the same for my daughter. I do the same for my wife. But, I also bought her long-term care because I didn't want that to take everything that she had and her to get terrible care. But like, think of that return that we just went over with yours, for $5 million. And here's the other thing too, that people are like, well, I don't want to put money into a whole life policy that, the insured is my parents because I won't have any money to use and I wouldn't be able to, but they're forgetting that there's this cash value, which you haven't hit yet. So, I mean, this is like one of the greatest places that a son or a daughter, one of the greatest places they could put money if their parents are still insurable. Like, they absolutely should have a policy on their parents. Like, no ifs, ands, or buts about it. It's a great place to put money. And although not an investment, because there's no risk here, you can't duplicate that kind of a return.
What, you mean life insurance isn't an investment?
Nope. Well,
no,
it's when you say life insurance isn't, a VUL is, an IUL should be called an investment, although it's not.
Well, they should be, but this isn't. Here we're working with contractual guarantees. Here we're working with dividends. Here we're working with companies that have paid dividends for over 100 consecutive years. It's maddening. It's maddening. Plus, you're able to access this. I said to my son, the great thing about this is, guess what? Susie Orman or the financial entertainer, Dave Ramsey, whatever, they're saying like, oh yeah, but look, your cash value grows and then how much of it is death benefit? Well, how much of that premium did you actually pay in order to get that death benefit? The point is the cash value grows inside the contract, and what can you do? Access it. So I said to my son, whatever business idea you have, where are you going to, you have a business idea and you need capital, who are you going to go to? Who are you going to go to?
One thing, Marty, that people are saying, I'm just looking at the chat here. People are saying that I was trying to, when we were doing this last example, I was trying to pin this up. So Stephen, Craig, you guys are saying you couldn't see this when Marty was talking?
Yeah, I mean, I can see
I can see it. It's just that we have all four of us pinned down.
Oh, no,
here.
it's on speaker mode. So as long as Chris is talking, it pops up.
Yeah, but I was trying to do it where I could just pin this.
I can pin it. Yeah, we can do that.
Yeah, so just pin this up there, and then Marty, like, a lot of people didn't really see this, but that's okay. And then this is what we were just talking about here. We were just kind of looking at a legacy plan, really, just putting money in. Your son, you were explaining to him, like, this is the place where you should want to put your money. But anyway, sorry about that. I'll let you keep going, Marty. I just was reading the comments. I wanted to make sure everybody was seeing the screen.
Yeah, I mean, the only thing that I'm trying to point out over here is not only, I kept saying to my son, the wonderful thing about, the becoming your own banker is you don't have to wait till you die to access that money. We have access to that money right now. What kind of business do you want? I said, if you're going to go buy a car, who are you going to finance it through? Or are you going to finance it through the Smithburg Family Bank using one of these policies here? Who are you going to pay it back to? Well, if you don't use your own policy, to whom are you going to pay? Well, you get a loan from one of my policies, whatever, and you're going to pay it to, because who ultimately is going to be the recipient of that death benefit or access to that cash value again? That's going to be you. That's the whole point about this thing. This is the way that it's going to work over here. And what everybody needs to understand is that zero line is the way most Americans live. It is a terrible, terrible thing that affects all of us. And most of us are blind to it there, because the terrible thing about our financial institutions is that they want our money more than we even want it. And they'll do anything and say anything to get it out of our pocket and to put it into theirs. So, I mean, that's what needs to be taken. There are three ways to finance things. You can pay interest to somebody else when you need a loan. You can save money and give up earning interest, but there is the third and the most wonderful way to do it. And the thing that this graph over here shows with that exponential growth in that policy is that you're going to be able to use other people's money. You're going to use the life insurance company's money. You're never taking money out of that life insurance policy. Your money stays in a uninterrupted compounding situation that you're going to take advantage of, that nobody really understands. That nobody, not even most life insurance agents, salespeople, advisors, understand how this incredible product works. It's just maddening to me. And I've been in the business almost 40 years now. And since I am in the New York City metropolitan areas, you would think people would be, oh man, people, they're smart, they're smart in New York, stuff like that. It's the exact opposite. They're rigid. They refuse to open themselves up to new ideas. They can't think on their own. All about this stuff about becoming your own banker is to be what you think is that's what you're going to become. You need to think differently about money. That's exactly what this concept tells you to do. This is what you say in terms of you're not going to have one policy, you're going to have multiple policy throughout your whole life. You're going to want them on yourself, your spouse, your children, ultimately, your parents. This is why you need to work with, this is why you need to be with the entire family. This is a generational idea. I mean, think about this. I think
Marty,
about, yeah, sure. Go ahead.
let me go into this. Like, there are a couple things that I remember in that email that you sent that I thought were really unique, and I want to ask the audience some questions. So folks, I'm going to ask a question, and in the chat, I just want you to put whatever answer comes to your mind. First question: what color is the black box in an airplane? In the chat, put down what color the black box is in an airplane. Should be an easy one for most people, all right? Okay. Very interesting. All right, look at that. Marty, what color is the black box in the airplane? Now, some of them probably got it right because recently there's been a bunch of aviation mess ups where they actually talked about the color of the box. But what color is the black box in an airplane?
Orange.
That's right. It's orange. So if any of you got orange as the answer, there's the black box. That's what it looks like. It is indeed orange. But now hold on. Let's go on to the second question. We're going to do 3 of these. What color is the purple finch? What color is the purple finch? These are not trick questions, folks. These are not trick questions at all. I love it. I mean, the first thing you would think, purple finch. Well, duh, it's purple. Let's see. What do you all think? Purple finch. What color is it?
Brown.
Somebody said brown. What color is the purple finch? Marty, what color is the purple finch?
Crimson.
Yeah, it's crimson. No one got that one right. Okay. Last question. Where did the Panama hat originate? Where did the Panama hat originate? Cuba, US, Cuba, Panama. I mean, that's the most obvious thing, right? The Panama. Let's see if anyone gets it. Nobody's got it yet. Italy. Wow. That's, I think Leonard was just like, hey, it's definitely not. I'm going to go way outside. Holy cow. Nobody's going to get this one right. All right.
I would say Mexico.
Ecuador.
Ecuador.
Yeah.
What was King George VI's first name?
Anyone know that one? But I mean, the whole point here is if you relate what we just went through to finance, one of the things we assume we know how money works. We assume money works this way because this is what we've been told. This is the myth. This is how we've been told. You want to buy a car? You can save up the money and buy the car, but then you lose the interest earning opportunity on all the money you saved, and you never get that opportunity back. Or what we've now been taught, and what largely everybody does, you mentioned with your agent that's buying the Mercedes, we go take a loan. And we feel so good about taking a loan, but then you're paying interest to someone else's bank. You're always arriving at the line zero. And the other thing we've been taught is to pay our bills and expenses first. And then what comes after that? Then we save. And how many people are saving? Well, look at the stats, folks. Look at the statistics. During the pandemic, all I got to say is, good job, everybody. Good job. Everybody was saving. It was nutty. People were saving over 10%. The first law of wealth, as said in The Richest Man in Babylon, is keep 10% of what you make. But what do you think people are saving right now? Less than 2%. Less than 2%. And I think it's probably dropped even more. But even though they're saving less than 2%, it's because they're saving what's left. What you're not seeing in that equation is how much debt the American family has right now. It is overwhelming. People are living a myth when all they need to do is change one thing, and that is where their money goes first. Then their money never stops working for them 24/7, no matter how much they buy. They always have access to their money, and when they repay their money, they're paying themselves back with interest. The same interest you used to give to the other person's bank, you now pay back to your bank. These are the myths, folks. And the best part is, The best part is, and I'm going to read what Shauna put, this whole understanding is deeply flawed, but that's the best part because now you realize it. Now you see the truth. Now you're starting to realize it. In the second segment of this wealth webinar, I'm so honored that we have 130 people. I was freaked out in the beginning because Zoom didn't send the reminder, but we got 130 people. We are going to go into some of the numbers and that. But before we do that, Marty, this is something I think you had said. You said IBC isn't magic. It's mathematics and strategy. And I'm just reading right off of this. The key to it, okay, so if IBC isn't magic, if it's not hocus pocus, if it's not some made up thing, if it's just math, we should be able to solve every single scenario somebody could ever throw to us mathematically. And the unique part is, we can, because of Craig's fancy spreadsheets and software. We can literally mathematically solve everything using this strategy. But that's all IBC is. It's just math and strategy. So there are three things that I have written down here that these are the only three things you need to understand. Number one, structure your policy correctly. Too many people think that this is just a whole life policy that you buy off the shelf. You just walk into the insurance store, 51 Madison or wherever in New York City you want to go. You walk in and you just buy a magic whole life policy. Wrong. These policies are designed and engineered. I said it earlier. Marty, you've said it. I'm going to say it again. They are designed and engineered to be high early cash value, which reduces the commission for the agent or advisor building the policy for you. So how many agents and advisors do all of you know that are going to be eagerly optimistic about reducing their compensation 60 to 90%? So you have 60 to 90% more cash value to use immediately in the first 30 days. Any? Because I don't know any. I don't know any financial advisors that I could go to that have never heard of this. And I sit down and I say to them, hey, listen, I know you got a great practice. I want to show you one thing. If you could solve your clients' problems and you could give your clients a lot more money and all you had to do was reduce your compensation 60 to 90%, are you willing to do that? The answer would be a resounding no. I can't. It's impossible. That's not even allowed, which indeed it is. So what I'm trying to explain, number one, your policy needs to be structured correctly, which means you need somebody to design and engineer it for you so that it solves your problem. Number two, you need to understand that the long-term benefits of infinite banking. And we're going to go into that in a second because I am going to mathematically show you what I mean by that. Because I know when I say long-term, people are like, oh, here we go. I got to wait for my money. I can't use my money right away. I got to wait 3-4 years. That guy down the street said I got to wait 4 years just to be able to take my money. That's the dumbest thing I ever heard. No, you'll have access to your money immediately in the first 30 days. But you've got to look at this long-term. Your financial picture in your life right now is a long-term picture. But this is what you're doing. You're saving, spending, borrowing, paying back, ending up in a pretty much zero-sum game where this game is a much better one. So that's number two. Number three is you need to use it just like the wealthy do, and you need to mimic. Because if you're going to become the bank, folks, you need to mimic what banks do. It is that simple. And I am going to outline all that and show all that. So what I want to do real quick, Marty, and then I've got a bunch of stuff that I drew out and I want to kind of bring this thing full circle mathematically with one example. And we could do any example. I just picked this one just because it was the only one we did right now. But I want to talk and I want to ask you actually, Shauna had put down on this sheet, because what we do with these wealth webinars is we literally go through and think long and hard about what we want to show you. And what we did is we wanted to bring all of you up to that moment where you're like, some of you haven't hit it yet. Some of you are like, well, okay, the commission's reduced 60 to 90%. I get that. That's probably why I've never heard about it from my advisor. And if I was going to hear about it from my advisor is probably not an advisor anymore. You're articulating certain things. But number one, why does this work? I think that's the most important thing. Why does this work? And you hit all of those, Marty. So if I can just cue you off, there are three things that we use here that make this work 100% of the time. Number one, the cash value growth. I'll let you elaborate. Number two, we're taking policy loans. We're using the insurance company's money so we don't have to use ours and our money can continue to grow. And number three, this is an investment, so it's guaranteed growth, but also a guaranteed legacy. What would you say about those three whys?
Well, the wonderful thing about cash value is that it just grows tax deferred. You're able to access it tax-free. What other, tell me other investments that you can do. Tell me other savings plans that can do that. Tell me other financial products that have those opportunities there.
Well, Marty, I think some people Some people would listen to that. They'd hear a couple of the things, and I'm going to play devil's advocate. I would say, well, Marty, I could do that with my Roth 401k, which there are very few of those out there, but I can do that from my Roth 401k. How would you answer that?
Your Roth 401k is from a guy who couldn't qualify for life insurance, understood the properties of how life insurance cash value worked, and said, well, we should give it to people. We could create something so that people have it just like life insurance without the death benefit. Well, that's even better. Except we're going to make them wait. We're going to put rules and stuff on it.
You're going to have the government telling you how much you can put into that Roth 401k every year. You can't just put whatever you want in. That government determines that. The government's going to determine when you can take money out of that. And not only that, you're not going to be able to, because we're talking about loans, and some people, I can take a loan for my 401k. Marty, what's the maximum amount that, as of today, that somebody can take as a loan from their 401k?
I believe it's maximum of 50,000.
Yep, or 50% of the value. So
Right.
it could be less than 50,000, but that's the most. So unless that person that says they want a Roth 401k because they think that's better than this, unless they can do everything in their life, finance everything in their life with $50,000, well, then that doesn't work.
Oh, and then the terrible thing about the 401k loan is, like, whose money are they giving you? Oh,
Yours.
Oh, SHID, they're giving you, it's your money.
Your money.
So what happens to that? You're never going to earn interest. You're never going to be in the market. You're not even in the market then. It's just taken out of there. And then guess what happens when you pay it back? What kind of dollars do you use to pay it back? Oh my God, I'm using after-tax dollars to put it back into pre-tax thing. So I'm going to have to pay taxes on this again when they come out, when I actually have a distribution. This is madness. This is crazy. This is why the guy who developed.
But this is the myth. This is the myth. This is what people believe. This is what they're told. So I'm just playing devil's advocate. So anything else on the why this works financially before we go on to the how? Because the how is so much more fun. The why is the why.
Right.
All right.
Well, it's, again, it's not, cash value. You use the principle of collateralization. It's wonderful. You're going to use the policy loans there. The strange thing people don't understand is once they understand it, it's crazy. I don't, if I got 2 minutes to tell a story.
Please.
All right. So I'm going around, I'm doing presentations, trying to explain how the infinite banking works. I used to call it Marty Smith's magic tricks with a question, because they weren't tricks. It's just math and strategy. So sure enough, a young agent advisor is speaking with an orphan policy holder, somebody who just had a $2 million life insurance policy, a term policy. So this guy, he got excited about the concept after I spoke to him. This guy, I showed him Nelson Nash's book, Becoming Your Own Banker. This guy got his own copy, so he was talking about it. But I said to him, listen, until you read that book and understand it, I'm not going to try to explain it. You got to read, you got to read the book. You have to have your own ha moment. You have to see how this works here. That's how it's going to work. So sure enough, this guy comes in, he talks about it. He's being explained what the concept is. He doesn't quite understand it, but they give him a copy of a book that explains how it works. So this guy, he didn't know who this guy was and what. So sure enough, this guy reads the book. He comes back and he says to the agent, he says, hey, listen, I've read the book. I understand now that there's a third way to get money to finance business equipment. It turns out he had a construction company. He says, so I understand that, there's a third way to do this. I could just finance it and pay interest. I could pay cash, whatever, or I could become my own banker. He says, well, the thing is, all these past years, all I would do is open up my checkbook and write a check and buy the piece of equipment and think I was ahead of the game. But now, after reading this book, I realized I have done everything wrong in my life financially up to this point. Like, oh, okay, yeah. He says, well, listen. He said, listen, Chris, I have to buy an $800,000 piece of equipment 6 months from now. So after reading this book, it would appear to me like I need to put like $1 million into a life insurance policy, and then I'm able to borrow out that 800,000 so that I could pay for this thing. And then I would still be earning interest and dividends and have a death benefit on top of all of this if I became my own banker.
Precisely.
Yeah. That's how it works. So literally,
he had his aha moment.
So that was the aha moment for the agent. I mean, not for that. So the crazy thing was, So we designed a policy so that of the $1 million he would pay, 870,000 would show up immediately as cash value, of which he's able to access 90% of immediately so that he can have his $800,000 loan collateralized, pay it, and have a tremendous death benefit on top of this. So when the agent explained this to him, he showed him an illustration that only showed paying 1 million in the first year. And so the business owner was thrilled, and he said, like, oh, this is great. This really, I can do it. This is fantastic. He says, but I have one question for you, Chris. Why wouldn't I put $1 million in every year? I got to buy equipment all the time. So that was it. So he didn't want to put it in just 1 year. He wanted to put it in constantly so that he would be able to become his own banker, be in control as he never had been in the 30 years that he'd been in business before. That's what the amazing thing about this.
That's phenomenal, but let me go one step further. I literally just had this happen. So I was talking to a dentist. He owns multiple practices. Every year when this dentist meets, and dentists, just so you know, docs, dentists, their business has adequate cash flow. It's pretty consistent cash flow, surprisingly, way more consistent than I thought. Every year, third or fourth quarter, his CPA says, hey, here's what we think your taxes are going to be. I need you to go out and buy more equipment. To which this dentist would go out and, buy more equipment. But he would finance the equipment because at the third or fourth quarter, he usually didn't have enough money to buy this really expensive equipment, because what he was trying to do, the accountant was trying to get him a bonus, like he was doing the 179 bonus depreciation on the equipment. So very common stuff. Most CPAs fully understand this. You've heard of landscape companies where they tell the landscaper, well, go out and buy a new plow truck. All right, go out and buy some more lawnmowers. You can write them off. It's all the same thing. So this dentist every year would go out and do this, but he would finance it. And I just happened to ask him, I said, so what do these finance companies with these dental equipment things charge? He said, well, most of them are double digits. I said, double digit, like how much?
Yes.
He said, well, just like a credit card. He said, they're like 20-some%, but it doesn't matter because I got the write-off. So, and then I'll just pay it off next year, but that's how we would do it. So when I got the money next year, I would just try to pay this financing off. But so right there, I like, to me, this is the dumbest thing I'd ever heard of. I'm thinking to myself, I'm like, holy crap. Number one, you're financing it. Okay, so you're paying 20-some% interest, every month until you pay it off. But number two, you're paying it off using money from a bank that now that money's never earning for you. And he just thought this is just the normal. He thought I was the dumbass, the one that was crazy for even asking these questions. I said, hold on a second. Why wouldn't you just change where your savings goes first? Put it into one of these specially designed whole life policies. And then when you buy the equipment every single year, whatever it is you need, you take the money from your bank, you make the same payments back to your bank. You didn't lose the earning potential on any of the money you put in there. Plus, if you pay your bank back the same rate you were paying those finance companies, you're making a 20-some% return. How much did you make on your 401k the last year on an average over 10 years? 10, 11, 12%. Pat yourself on the back, kick yourself in the ass because you just made yourself 20-some% guaranteed. Plus, you made a spread on your money because you still earned interest and dividends on all of the money. This is the moment. Yes. So I got really excited you mentioned that. And it doesn't matter if we're talking doctors, landscapers, equipment, anything. But it's just like, this is what everybody does. This is the myth.
Yes, it is the myth. And it's a hard lesson. I mean, the thing about when you understand becoming your own banker, it really does say you need to think differently about how money works and about how you've been using it. And lots of times people, they want to resist. But again, if you have that moment, the point about this is, guess what? There is no past. There is no future. There's only this moment right now. We can only go forward from what we're doing today. We can't make up for anything that we've done incorrectly or things that we regret in the past. What we need to do right now is say, I need to become my own banker. I need to take my money out of this particular investment or this particular brokerage account, this particular savings account. I need to put it in a different place that is going to give me all the wonderful, unique tax advantages and opportunities to access money and to be able to get it without creditors, if anything happened, whatever, coming after my money. They can't get it if it's inside this wrapper, inside this whole life insurance policy in most states there. I need to think differently and I need to use it. I need to be able to explain right now about what I'm going to do with this money that I'm going to do differently. What do I need to finance? Is it going to be my car? Is it going to be my kitchen repair? Is it going to be my business equipment? Is it going to be a down payment on a piece of property? I mean, what's the other myth? How much of your down payment, how much did your down payment on your house, earn for you last year?
Nothing.
Nothing. Right? If you put more money into your, into your mortgage there, be an additional payment, how's that going to affect the value of your home? Nothing. The property's going to appreciate whether you have zero equity or 100%. Doesn't matter.
Well, Marty, I'm going to transition this into the next part because I know we got a bunch of people on here and they all want to see some math. But the one thing, folks, if any of you are interested in learning more about this, seeing how this can solve your problem, listen, the best part about the infinite banking concept is we don't need to convince any of you. Okay, you're going to see it for yourself in a second. If you haven't seen it already, you're going to see it in a second. So there is no convincing. So when you book a call with us, we're not trying to sell you anything. We're just simply trying to solve your problem. And you know what you're going to do? If we can solve your problem by changing just one thing and adding one step, guess what you're going to do? You're going to ask us to help you solve your problem. You see how that works, folks? But let me go in. There's just a few more things I want to hit, and these are awesome takeaways. And Shauna did such a great job. I'd be remiss not to do this. I want you to think like the wealthy. Just logically, just shut your brain off, stop writing, and just listen and just think about this, because this really even surprised me. Okay, oil reserves, banks, real estate, even Hollywood operate using leverage. They don't liquidate money. They operate fully on leverage. So take that for what that's worth. Let's go deeper into this. The United States has a massive oil reserve. We all know this, okay? A little less since the last administration, but we have a big oil reserve, both in the ground and in strategic petroleum reserves, SPRs, okay? The United States of America, look up any geopolitics book. The United States is one of the richest resource lands in the world, okay? But most of it's in the ground. Why? We could drill all that, pump all that, but instead what we do is we use our own oil. The US often imports oil. Instead of using our own oil, we import oil from other countries like Canada, the Middle East, and all those. We import oil when we have our own oil here. But just keep going with this. Why would that be? Well, because it's more strategic to keep our reserves intact. Now start thinking about that. It's more strategic to keep oil reserves intact for the United States. It's more strategic for you and I to keep our cash reserves intact. You saw that. I'm just trying to kind of pivot this. So what they do is they leverage them. They leverage our strategic oil reserves, and instead of draining them, the U.S. can sell or lend oil to allies, controlling pricing. They do this all the time. So when you parallel that to the infinite banking concepts, instead of spending your cash, using the oil, that's the parallel, okay? You borrow against it. You import the oil, but you borrow from the insurance company because they let you do that. And billionaires, let's move to billionaires. Now we'll get away from the US. Billionaires and real estate moguls especially, they don't sell their high value properties when they need money. What do? They borrow against their assets. And there's videos, there's training course. You can buy courses for $30,000 showing you how to leverage your real estate and use that money tax-free. Kiyosaki does it every single day. And all he's doing is showing you how not to deplete your assets, but just leverage them and borrow against them. That's how they do it. They use it as collateral. Okay, that's because they keep the ownership. They keep control. Everything we're talking about here with the infinite banking concept, with these policies, it's about you controlling your money, which right now, the majority of the United States population is not in control of their money. They think they are, but they're not. They take their money that they've worked really hard for, and they put it in a bank. They put it in a 401k. They put it in a Wall Street account. They do something with their account that puts somebody else in control. But they're like, no, that's my money. I control that. Nonsense. If you controlled your money at the bank, would the bank not have to call you if they were going to lend your money out to somebody to buy a 1965 Ford Pinto? I don't even think they made Pintos in 65, but whatever. Yes, they would. And you would be like, hell no, I'm not lending my money on a Ford Pinto. But do you have that right? Nope. The bank can lend your money to anyone for anything at any rate with any risk, and there's nothing you can say about it. So therefore, you are not in control. The 401k, you put your money in the 401k. Do you control the 401k? No, the plan administrator does. You have no say in what funds are offered. Matter of fact, the next year, they might remove your favorite fund, and there's nothing you can do. You get a little letter in the mail that says, hey, we got rid of that fund, and you're moving this one. And you're like, I don't like that one. And they say tough shit. Matter of fact, they don't even say that. They just say, oh, well. All right. So that's what we're talking about. It's about control, folks. When you parallel that to what we're talking about, this is all about control. First and foremost. Lastly, big studios, Disney and Warner Brothers, very wealthy companies. You all know that. You can look up their stock. These companies are sitting on billions of dollars in cash. But did they finance their own movies? They do not. Not one of those big production houses, not Disney, not Warner Brothers, none of them finance their own pictures. They go out and raise money and they leverage it so that they don't dilute their money. The infinite banking concept follows these exact same principles, folks. It does the exact same thing. The world's biggest and wealthiest industries all do the same thing we're telling you to do. So, folks, this is nothing new. It's just something new to you. It's been around forever. It's been being done forever. Everybody else knows about it. It's in the elites, in the wealthy side, but yet we're not taught this. Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris. So let's go on to one thing here. So what is involved? What do you got to do to make this happen? So this is going to blow your minds, folks. I promise you, but I got to walk you through it. So what we're going to do is we're going to do a comparison, because this is the thing people always say to us. I got the naysayers all over the place. I got millions of people out there that we touch with all my social media, and I hear it almost every single day. Chris, that's the dumbest thing I've ever heard. Why wouldn't I just put money in a bank account and lend that money out from a bank? Because what we're going to look at today is an example of private lending on Private Money Club. I just picked this because I could duplicate this. But if you don't like that, replace it with that equipment. Replace it with that dentist buying equipment every year. Replace it with buying a car. It doesn't matter. It's all the same thing. Replace it with paying off your debt, which would be a higher return. So again, doesn't matter. I'm just going to do one. So put your money in a bank account. So I have the stats of bank accounts. So over the last 10 years, only 10 years, the average savings rate in this country is 0.42%. Now, I know some of you are like, yeah, Chris, I'm getting 4% in my savings. Yeah, you won't when the Fed drops interest rates. And if you were listening to Trump, he was saying, I want rates going down as tariffs go up. So I know the Fed doesn't listen to the president, but there's going to be a meeting of the minds. Rates are going to continue to go down. Your savings accounts will continue to pay you less. Just a fact. Sorry. But 4.2 is the average. So what we're going to do is we are going to do a comparison where we're going to run a bank account in lending. So we're going to take money from your fancy dancy bank account and whatever rate of return you want, doesn't matter. And we're going to lend that money on a real estate deal at 12% interest. Now, let's just see how lucky I can get here. I want to do a shameless plug for Private Money Club. So here's Private Money Club. It's free for everybody. So when you go in here, I don't look at any of these deals. Here's the first two deals. Tactical cash flow deal, 20% for 24 months, $45,000. Here's a first lien cabin loan for $25,000 minimum, 15%. So here's couple 12%ers. So what I'm trying to show you is when you're thinking, I don't know how to make 12%. Well, here it is. Here's 20, 6.5%. Okay, that's a low one. 20, 30, 30, wow, 30, 33, 12, 15. So is it, now that I keep going, is it okay if I use 12%, folks? Do you think that's good? Right here, 14% first lien position. I just wanted to show that just so you don't think I'm just pulling numbers out of the sky. I actually used the low number. So we're going to use an example, and I thought it would be best if I just show you a real policy. So we're going to use a policy that I started when I was 44 years old. I'm 47 today, but when I started this policy when I was 44, I started it putting $1,500 a month into it, $30,000 a year. So I'm just going to use my numbers from my policy that I started. It's no different. Matter of fact, it's a 60-40, 60% PUA, 40% base. So some of you that know what that means, because you've watched how to design an IBC policy updated on my YouTube channel, you're like, wow, why would you have done a 60-40, Chris? You should have done a 75-25, maybe an 80-20. You should have done one that gives you more cash value. I didn't, because I understand how this works and I understand the long-term benefit of that base. But that's not important for today. I'm putting $30,000 into this policy because I used to save $30,000 in a bank account. I just changed one thing and that's where it went. I did that because I wanted guaranteed interest. I wanted dividends. I wanted them to be tax-free. I wanted my money protected against judgments and liens. Even in New York State, we have protection against judgments and liens. Imagine that. I want it to be private. I don't want anyone to know how much money I have. I don't care how much they want to research me. You know, everybody, when they see somebody online, they go on and they say, what is Chris Naugle's net worth? Well, you know what? If you pull up what Chris Naugle's net worth is on one of those sites, you know what you're not going to see? How much money I have in policies. Why? Because it's private, folks. It's private. And not only that, I love my family, especially my little girl. She's 4.5, little Vivi. So I want to make sure that she's in a better place, just like Marty was talking about with his son. And I'm going to do that same lesson with my daughter when she can understand it. So those are the reasons why I used whole life. So what we're going to do is we're going to run a scenario, and pay attention, folks. I'm just going to show you the infinite banking concept and how simple this is. I put the money in this specially designed whole life. I immediately find a deal on Private Money Club that's $30,000. I take $30,000 as a loan from the insurance company. This insurance policy charges me 5%. Okay, yours might be different. Yours could be 5.25, 5.35, but this particular policy, I looked it up, it was 5%. I'm going to take that loan. That $30,000 is going to hit my bank account within 36 hours from when I take that loan. Sometimes faster, but it's never taken any longer, okay? 30,000 hits my bank. I am then going to wire the money to a third-party escrow that is then going to be lent to a deal in a first lien position on Private Money Club. That person is going to pay me 12% interest. Now, when they pay me 12% interest, that 12% is going to be paid to me monthly. And over the course of 1 year, $30,000 at 12% would have earned me $3,000. Now, let me ask you a question, folks. If you did this, where would you put that $3,000 in interest? Put it in the chat. If this was your deal, you now took money for your policy, you lent it out on Private Money Club at 12%, you're now earning $3,000 a year. Where would that $3,000 go? As you're doing that, well, I love it. These folks are way ahead of where I was, but most people would put it into the bank, and you would too, and I did. So I took that $3,000, I set it up. So actually, I set it up right from the borrower, where they just put the money right back in this bank account, my segregated bank account. Although, just so you all understand what that means, it means it's not my normal bank account that I pay my bills from. This is just a bank account I set up just to do my infinite banking stuff. I wanted to keep it separate. The $3,000 goes into the bank account. Now, do I want Chase Bank, who pays me nothing, just so you all know, I get nothing from Chase Bank, 0 interest from Chase Bank. Do I want Chase Bank holding my $3,000? Nope. So what I'm going to do is I'm going to set up what's called a loan repayment form. Security Mutual, I have a policy with Security Mutual, and they're the best customer service in the industry, bar none. I call Security Mutual, a giant mutually owned insurance company, and I get somebody on the phone every time within 2 minutes. They are on the phone, but not only are they on the phone, when I explain to them what I need, they know. They go through their little security check and they know exactly what I need, and they send me exactly what I need. So I get that loan repayment form, I fill it out, I sign it, I put down, I want to repay $3,000 a year. And all I do is I set it up so that I take from my segregated account and I draw it out and I put it back into my whole life. Notice how, if I look at this, I created a complete circle. Anyone ever really think about a wheel on your car? You know how it goes down the road really smooth? It's because that circle just goes round and round. Remember when we were kids, you know, the wheels on the bus go round and round. That's all we're doing here, folks. But you know, have you ever thought of what would happen if on your car, you grabbed a chainsaw and you just, I don't know, went nuts on the tire and you did this? You got rid of that part of your tire. How smooth does your car go down the road? Not very smooth. You're not getting far with that, right? This is where people make the mistake with the infinite banking concept, because this is where they stop. They don't put the money back into their bank, but I do. You see, just like I showed you a second ago, the money's going to go back into the policy. I'm going to recycle and recapture it. It is a loan repayment. And you know the best part about this? It is a mathematical guarantee that you're going to make more money if you do this, because here's how it works. I took a $30,000 loan from the insurance company to which they charged me 5%. If I don't repay that loan, the insurance company will gladly keep charging me 5%. But you see, when I repay that, the next year I pay $3,000 back to the policy. How much money do I have in my policy when I put that $3,000 that was interest from the borrower back into the policy? Marty, how much money do I have immediately to use? $3,000, right?
Yeah.
If I move $3,000 back into my policy as a loan repayment, I have $3,000 to use the next day. See, people think loan repayment is a bad thing because when they make their car payment, their mortgage payment, they don't have $3,000 in the bank account. They have negative $3,000 in their bank account, but I got $3,000 back in the policy. But I also now only owe $27,000 to the insurance company. And that means the insurance company can only charge me 5% on $27,000. So if I keep going, wheels on the bus go round and round, and every year I do this $3,000, I'm diminishing the amount of the loan, the amount the insurance company is charging me, because that's called an APR. It's how mathematics works. But never once in any of this time did I make any less in interest? Did I make any less in dividends? It still continued to pay me on the full $30,000. Here's the circle. This process, this is called the infinite banking concepts. You're going to make money twice on the same dollar over time because of a spread. You're not just making 12%, because when you do it from a bank account and you take $30,000 from your bank account and you buy, or you would lend it on PMC, you don't have $30,000 in the bank. The bank's not paying you that measly 0.42%, okay? That money's just making money one time. You see here, I'm making money twice because my policy is still paying me interest and dividends on the full cash value, even though I took the cash value out and used it to make money a second time. Does that make sense? But now I'm just going to show you the math. And we're going to talk about the long-term approach to this. But I've got a little sidebar secret that I'm going to share with you. Can everybody see this? This is my policy. Dollar for dollar, cent for cent. This is right off my illustration. It took me a while to put these numbers on here. $30,000 going in. It's a little bit less than $30,000 because I'm doing it monthly. So you can see here's my cumulative amount. Years 1 through 15. In 15 years, I put $359,100 into this policy. Now, what we're going to do is over on these columns here, these ones right here, we're going to look at the numbers, and I'm just going to call them out because I know they're small. But this column right here is if I took the $30,000 from my bank account and I lent that money out at 12% and I put that money back into the bank account. So you can see I'm making a return on that money, because even when it's just sitting in the bank account, I made 0.42%. I made $126 on my $30,000 in that first year, because I'm going to show you this. I'm going to show you the loan that I'm going to take out for that PMC deal is in year 4. Why? Because I'm 47 now, folks. When I started this policy, I was 44. So I wanted to make this real. So if I took $30,000 out in the 4th year and I lent it from my bank account, okay, that's my return. But if I did it from my policy, this is my return. Now, here's the unique thing. Policies, when we buy a whole life policy, specially designed and engineered, doesn't matter what whole life you buy, guess what the insurance company does? Because they are greedy. They charge us. Can you believe the nerve on these insurance companies? They actually charge us for that death benefit. They charge us a cost of insurance. So this insurance company, day one, gave me a death benefit of $765,367. And those bastards actually charged me for that death benefit. But not only did they charge me for the death benefit, they charged me a policy service fee, $50 a year. Talk about greedy. And then not only that, that agent, me, got paid a commission. About 11% is what my commission worked out to be on this thing. 11% of that 30,000. Yep, I got paid that. So all of that had to come from somewhere, and it came from my cash value. I put 30,000 in, and I only got $27,534 to use, or $534 to use. So in other words, if I had just kept the money in the bank account, I would be ahead by $2,592. I lost 8.22% for doing this stupid policy. And I did the same thing the second year. I put the money in the policy the second year. I didn't even have my 60 grand. I only had 57. So I lost 4.72 that year, down $3,204. And this pattern continues every year for a period of 7 years. So for 7 years, I would have been better off lending money from the bank account. Everybody understands that? But for 7 years, let me ask you another question. Was my family protected? Yeah. Remember those insurance companies, those greedy insurance companies, and I want them to be greedy, and I'll explain why in a second. You know, they promised that if I died in the first year, I'd make my family, let me clarify, because I'd be gone, my family would get $765,000. But the second year, my family would get $829,000, and then $893, then $926, then $989, and then by the sixth year, my family would get over $1 million in death benefit, all the way up to the eighth year. This eighth year right here, my family would get a death benefit of $1,174,238. That's my death benefit. Stay with me, because here's what the Prime America, and I call them out all the time. I get in arguments with these idiots all the time. They would say, yeah, but Chris, you'd be better off buying term and investing different. So I said, well, maybe you're right. Maybe I would be better off. So I went in there and I said, okay, to be fair, I want to buy a $1 million term insurance policy. And I'm going to buy that, and I'm even going to cheat the system because I'm going to buy that at age 44, and I'm going to assume that I'm a preferred rating. So I'm giving myself all the bells and whistles here on this, and I'm going to do the gusto because, hey, listen, if I'm going to compete with a whole life, I better do the longest term. So I'm going to do a 30-year term policy. And if I did all of that, my premium on that term policy is $2,875. Just remember that number. That's how much the term would cost. So the people would run the math and they would say, all right, well, the term is a lot less than the whole life. And I don't know though, because the first year I had 765, now they'd have $1 million. Was the term more or less than what I actually lost? Term was more. But then, you know, they made a little interest on their bank account. And, you know, if it was a Prime America person, they'd show you like some Pioneer A share so that they get their front end load. Anyway, we won't go there. But anyway, the next year I was down 32. So the term was cheaper. So if I did all of this and I just sat there and I just said, okay, how does all this stuff shape out? The mathematics behind it. So remember, for 8 years, I made more money putting money in a bank account and lending it out, even after buying the term insurance. Okay, so how much more did I make? Well, I did the math for this. So here's the term. Just remember 28.95 or 28.75. I need some room here. Just follow with me. This is where it gets really fun, folks. 28.75 was that term per year. Okay, so 28.75, I got to do the math here. If I were to add that up over 8 years, because it took me 8 years, 28.75 times 8 years, it's $23,000. 8 years, 23,000. Had to double check that. It's weird that it comes out to a round number. So then I just went in and I said, okay, how much more money would I have made? So if I did it from cash, what was the difference? So let me just come over here real quick. I want you all to know how I'm doing this. This is very simple mathematics. What I did is I went in here for the 7 years, because we lost money for 7 years in the policy, and I added up all of my losses, okay? How much did I lose? Well, when you add that all up, I lost $28,856. That was the negative. That was the negative draw. I lost $28,000 to this. But I could come in and subtract what the term would cost, 8,765, so 58.56 would really be the net. But let's not do it that way, okay? Because these buy term invest the difference people, they're special breed. But we all know, like, really over that 7 years, my net loss, if the term was bought, was 58.56. But you know what? Let's not do that. I lost $28,856 over buying or investing from the bank. So now what I did, the 8th year is my crossover point. It took me 8 years to basically make more investing or lending here. I made $327. But you see, because of uninterrupted compounding interest, remember, I'm making money twice on the same dollar. I'm making that money on all of the money I put in. So how much money did I put in? $239,300. How much cash value do I have? $261,751. Meaning if I took $261,000 out as a loan, I'm still getting paid interest and dividends on $261,000. Hence, my return now turns positive. And over, all I'm going to do is I'm going to do the same amount of time. I did 7 years up here that I lost money. I added that. Now I'm going to take the next 7 years and I'm going to add up how much money I made. I made 327, 5,211, 11,898, 21,635, 32,656, 44,988, and 58,706. Add all those up. How much money do I get? Well, that means I made over those 7 years an additional $175,421. But I lost $28,000. So what's the difference? $149,565. Plus, by the end of that, I have a death benefit of $1.362 million. Oh, I forgot to tell you all that any interest that the bank pays you is taxable. I didn't factor that out. So given the whole thing, this program that I just showed you by the math, if I did this for not even 15 years, if I did this for 14 years and I compared side by side, buy term invested difference versus buy that whole life and use the infinite banking concept, mathematically, I actually came out with a lot more than this, but let's just be fair and not even factor the term. I made $149,565 more. Plus, I have a death benefit of 1.362 that doesn't end in 30 years like my good old fancy term insurance here. No, it lasts for my entire life, hence the name whole life. People ask me, well, what does whole life mean? It means you're protected for your whole life. You can't outlive it. And one person earlier had asked me a question: what happens when we go into a recession, when everything falls apart, the dollar goes to zero, blah, blah, blah. We could just throw any scenario. What happens to these insurance companies? What's an interesting question? I'm gonna have Marty kind of chime in on this, but then I want to take some questions. First and foremost, it'd be interesting for the person that thinks mutually owned insurance companies are going to go belly up in this next recession, because that would tell me that they haven't gone back and looked at the Great Depression. And they haven't looked at the crash in the 1980s. They haven't looked at any of the other recessionary periods, including the dot-com, the Great Recession, and including the pandemic. What happened to, come on, all those recessions, these insurance companies had to have just been going belly up. Because, banks went belly up. Lehman Brothers, all the big, too big to fails, they all went belly up. So these insurance companies had to go belly up, right? Marty, I don't know if you know this, but how many mutually owned life insurance companies have gone insolvent and bankrupt?
I don't believe there's many, if any. During the Great Depression, I think 10,000 banks went out of business. I don't know if any life insurance companies went out of business. That's the
Publicly
thing.
traded life insurance companies may have, like, back in 2008, what was that one? Gosh, it started with an A. What was it?
AIG.
AIG. Yeah, AIG went belly up, but did any of the clients of AIG lose any money? Even though they were publicly traded, shame on them. We're talking only mutually owned insurance companies. Craig, you know this, but how many of AIG's clients lost a penny? Did
None.
any of their clients lose anything?
None.
None. Not a single client of AIG, the riskiest driver in the insurance world, because they were insuring like 120% of their risk. Not one person lost money. So when we go back to the mutually owned insurance companies, if any of you do the research and find a mutually owned insurance company that did go insolvent, not one of their clients lost money, because not only do insurance companies have a completely different way of managing money that makes them a lot less risky than banks, but there's a state insurance fund that guarantees that those clients are protected. Because how it happens, if a company goes insolvent inside of a state, they go through a rehabilitation to determine what's going on. And then all the other insurance companies in that state have to pool money in to buy up or basically make whole all the policyholders in that company. In other words, usually the companies split up and everybody takes their share, but no client ever loses any money. But just in case the state can't handle it and the other insurance companies don't have enough money, there's a federal backstop as well. It's too bad we didn't have these kind of things for banks, but hey, we're not going to go there. There's only the FDIC. And if you do the math and you look at the FDIC, how much money they actually have for how much money they guarantee, well, you will not feel so good about that. But with insurance companies, there is no issue, and there will be no issue, no matter how bad of a recession, depression, or whatever the hell we see in the future. That's not going to happen. Your money will be safe and sound. But Marty, now that I've kind of done this, and I thought this math was really amazing. We have a lot more on this, folks. Like we show every single year the money flow, but this is the mathematics. You come out ahead 149,565, but you sucked a little bit of wind for 8 years. But they always say buy term invested difference is better, but by the math, it's not even close to being better. So in other words, this was the last thing I wanted to show. Let's just say we did roll in that term insurance. Remember, I was down 28,856 over the 7 years. The term insurance cost 23. So pay attention, folks. This is going to be really fun. So I'm going to take my calculator. I'm going to go 28,856,000 minus the cost for that 30-year term, 23,000. That comes out to be $5,856. Now let's divide that by 7 years, because this was over a 7-year period. That would mean that anyone that's telling you that buy term invest the difference is better, and let's only do 7 years, they would have to be able to sell you a $1 million term policy for 30 years for $836.51, because that's what it cost me. My net cost for almost, well, $795 up through $1 million every year was $836,051. And every year that goes beyond that 7th year, this number starts to turn positive. The insurance company is literally paying me to have insurance. Not really. I can't legally say that compliance-wise, but like
you can't.
mathematically, what's that?
Well, as Nelson Nash would say, how much does whole life cost you? And his answer was always nothing. It's nothing.
That's right.
Yes, I mean, people have to understand that. I mean, where can you find a product where you actually give the company $30,000 of premium and then within a few years, they say, oh, well, you still have your death benefit, which is increasing, and we're going to put that $30,000 you gave us. Oh, you have access to that immediately, that entire amount. Wow. Wow.
And the death benefit's tax-free.
Death benefits tax-free. Policy loan is available, access without any taxes. It's, hey, if you don't have your moment, it's like, what are you going to do? What are you going to do differently? How is this going to affect what this is once you see that wheel of how it can work here? Again, you want the velocity of money. You want money being moved. You want to be able to make money on money here. That's what this is all about. This gives you the opportunity. People have to understand this is compounding uninterrupted. You could take almost, if you took 100% out of your cash value, whatever, if you could possibly do that, it's still going to earn the same dividends that it would have if it was still in the policy. You're crazy not to use it for opportunities. Every time you think about money, you have to see what opportunities are out there. You need to open your eyes, be available to it. If you're a business owner, this should be the most natural thing in the world for you to do.
Love it.
Whenever you're going to buy something, whenever you're going to make an investment, if you take money out of the bank, are you going to earn interest on that money in the bank? No, that's gone, lost forever, consumed. If you take money out of your stock, you have to sell a stock or a piece of property. That money is never going to earn interest or dividends again for you. But the only place where you can use it, where you can use this collateralization over here and have a death benefit, is in that dividend-paying cash value whole life insurance policy. It's the most phenomenal product ever created.
Completely agree. So with that being said, folks, I mean, I don't know how to give you more conclusive mathematical proof that this strategy works every time. Doesn't matter whether you're doing a private lending deal, debt, equipment, cars, you name it. It's all the same. We just take one out and plug a new one in. We have the software to do this. And again, like I said, we don't convince people that the infinite banking concept is working for them. They see it themselves. If all of you didn't see it, and I know you did, because I can't even get to the bottom of the chat. And kudos to all of you. There's 119 of you left. We're 10 minutes over time, which we started a little bit late, but literally I cannot get to the bottom of the chats. I can't even imagine what Craig and Steven are doing here. They're trying to answer all your questions, but the best thing for all of you to do is just book a call with us. Book a call. Let's go through your scenario. Let's run your math like we just did this. Let's look at how this will solve your problem. That is what your next step is. And if you're still questioning it, well, the best part is this video, this recording will be edited and put up on my YouTube, where it will join, as of today, 1,100 other videos teaching you how to take back control of your money. Yes, over 1,000 now. So over 1,000 videos teaching you how to take back control of your money and teaching you how to be the bank. And in doing so, it will show you how you will take back the banking functions in your life. With that being said, Marty, thank you so much for your wisdom, your time, and just everything you're doing out there. Thank you for continuing to push this forward. Stephen, Craig, thank you both. Craig, thank you for helping put together all those numbers that we just went through, because I know you got a spreadsheet for everything and you had a spreadsheet for that. So thank you for that. And thank you to every single one of you who are on this particular webinar, because you just saw something that has the potential to fix your problem. Your money problem, that is. I can't fix all problems. And I certainly am not willing or able to fix your mindset problem. So that's why it's important that every one of you has that moment and you realize most of what you've been taught about money up to this point has been a myth. And now you're seeing the truth about money. And I'm going to end it on that, and I'm going to hit a couple more questions. So thanks, folks. Join us at 4:30 p.m. Eastern for Ask Me Anything, where we get together Brady Bunch style to teach you, not even teach you, just to answer your questions. We're not going to teach you anything, but we're going to have some fun, and we're going to answer your questions. Till then, thank you. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.